Hello guys, welcome back to the FX Academy, and in this episode we shall be talking about the Japanese candlestick patterns, the basic candlestick patterns, and these are one of the most useful single candlestick patterns you guys should know, because these are very, very crucial in the market when doing your technical analysis, because this one defines the zone and define the entries and define the exits. So guys, stick to the channel so that you watch till the end and get to know what these candlesticks are. So starting with the basics one, we have what we call the spinning tops. Spinning tops, these are Japanese candlesticks with a long shadow. When I talk about a shadow, I mean a week, like weeks, a week, and a long lower shadow or week, another week, like they are weeks, and small real bodies, and these ones are called the spinning tops. Their color does not matter, whether red or green, like whether bullish or bearish. The color doesn't matter as long as you see such a thing under a candle. There's a meaning for that. The spinning top pattern indicates the indecision between the buyers and the sellers. Now the market is neutral. Like the indecision means the market is neutral between the buyers and the seller. No one is buying, no one is selling. So the real body shows little movement from the open and close of the market, and this one also indicates that both buyers and sellers were fighting out, but nobody could gain the upper hand. Like no one won the side of the market, because we all know that the market must be going up or down. When it's going up, these are buyers. When it's going down, these are sellers. So when these candlesticks come up, the market will be a sideways. Like it won't be going up nor going down. So basically, that's what we should know about those candlesticks. Another thing you should know is that even though the session opened and closed with little change, prices moved significantly higher or lower in the meantime, but neither buyers nor sellers could gain the upper hand, and the result was a standoff. So if a spinning top, before that, you should get to know this is a spinning top. I made this white and this black because the color doesn't matter. So the white one is a green one in our Japanese candle charts, and the black one is a red one. So basically, this is what we all meant. Like it is having a long upper wick. This is the upper wick, and a long lower wick. However, I call them shadow, but we can also call them wicks. So this one is a wick, long upper wick, like their wicks down and up are long. And the body, they're having very low or very small bodies. You see like a body is very small. You find it like you can find a candlesticks. I know you've been seeing them in the market, and it's like this. It's having a very small body with longer wicks. We've been finding these candlesticks, but this is the language of the market. It communicates via candlesticks. If you learn to learn the meaning of this candle and why they have been formed, then you will be good to go into the trade, because you'll be understanding the market, the language of the market. So when these candlesticks form, what should we know about that? If a candlestick forms during an uptrend, this usually means there aren't many sellers left, and a possible reversal in the direction could occur. Like if it forms when a spinning top forms during a downtrend, like you've been moving down, and then it forms here, like it indicates that a reversal might come. Like there aren't many sellers, like the sellers are getting exhausted, and so we should wait for a possible reversal. Like it could reverse into another trend, an uptrend. We shall learn about the trends. We shall learn about the uptrend, the downtrend, and all types of markets and market structure in the later on videos. So this is a spinning top. We shall see that on the chart and how it is traded. Another candlestick you guys should know, we have the hammer and the hanging man. These two, I've combined them because they look alike, however they have different meanings depending on where they've been formed, whether on the uptrend or a downtrend. So the hammer and the hanging man look exactly alike but have totally different meanings depending on the past price action. That's what I've been talking about, like the past price action, whether it's been an uptrend or a downtrend. Both have little bodies and their colors don't matter, whether it's bullish or bearish, like whether it's red or green. The color doesn't matter, but they have a long lower shadow. For them, they have a long lower shadow and a short or absent upper shadows. Some, like for them, they are like spinning tops. However, for them, they only have a long lower. At times they have no upper or very little upper shadow. It can be having very little or not even having anything. So the hammer is formed during a downtrend. Like you see, this was a downtrend, prices were moving downwards, and then we had a hammer. This is a hammer, like they look alike depending on whether the names depends on where they formed. So if this one formed during a downtrend, it's a hammer. It could be even black, like it could be red or green. The color doesn't matter. But if you see a candlestick like this having a small body with a long wick downwards, that's a hammer. And with this, we know that a possible reversal in the trend is likely to occur. So this is a hammer. But if it's an uptrend and the prices are moving up and eventually we find this, then this is a hanging man. And when you see such a candlestick, just know that you shouldn't continue buying, whether you should wait and see if prices will turn, because this candlestick, it shows that now buyers and sellers are fighting aggressively, and now a possible reversal might occur. So that's the hammer and the hanging man. We shall get to know on the charts later on. We see how these candlesticks are traded. Now let's talk about these guys. A hammer. What's a hammer? A hammer is a bullish reversal pattern. You should know that it's a bullish reversal pattern. When I say a bullish reversal, like it turns the downtrend into an uptrend, like, because being bullish we are going up and being bearish we are going down. So it's a bullish reversal pattern that forms during a downtrend. When the price is moving or is falling, hammers signal that the bottom is near, like the end of the downtrend is almost near, and the price might start rising again. So that's the language on how the market communicates to us as traders. The long lower shadow or wick indicates that sellers pushed prices lower, but buyers were able to overcome this selling pressure and caused near the open. Just because you see a hammer, you should know this, just because you see a hammer form during a downtrend doesn't mean you automatically press a buy order. No. More bullish confirmation. We need confirmation, bro. More bullish confirmation is needed before it's safe to enter a trade. A typical example of a confirmation would be to wait for the next candlestick. We should wait after that closes. You should wait for the next candlestick to see if it closes above the hammer, and if it closes above the hammer, then you're good to go, man. We shall talk about more about that in the later on videos about the risk management and everything. But it's more important you first learn the basics, so when you get to the charts and learning candlesticks, doing technical analysis, you know what we are doing and what every candlesticks mean. So how do we recognize, like, how the criteria for us to recognize that this is a valid hammer? These are the criterias. One, the long shadow or the wick is about 2 to 3 times the real body. So if you see the body and the wick is long enough for this body to fit more than 2 times, then that's a valid hammer. It should be having little or no shadow up, like the upper shadow should be having like this is the body, and then we have the long wick down, so it should always be having little or no wick up. The color of the real body is not important, whether it's green or red. So the criteria, let's talk about the hanging man. Hanging man, for him, is a bullish reversal pattern. Like, it can mark a top or a strong resistance level. When the price is rising up, the formation of a hanging man indicates that sellers are beginning to outnumber buyers, however much the price is moving up. So when sellers start to outnumber the buyers, that signals to us that sellers might turn the market downwards, because for them they always turn the market into a downtrend. The long lower shadow shows that sellers pushed prices lower during the session. Buyers were able to push their prices back up near the open. This should set off alarms, since this tells us that there are no buyers left to provide the necessary momentum to keep raising the price. So we get to know that if you say hanging man, you should know very well that prices might turn downwards from an uptrend to a downtrend. So the criteria you should see whether the hanging man is valid are the same as the other. So the long shadow is about 3 times of the body. There should not be there should be little or no upper shadow. The real body is at the upper end of the trading range. So the color is not important, though a black or red is more bearish than a white body. Another candlestick pattern, single candlestick pattern you should know, is the inverted hammer and the shooting star. The inverted hammer and the shooting star. The inverted hammer and the shooting star also look identical, like the hanging man and the hammer. The only difference between them is whether you are in an uptrend or a downtrend. An inverted hammer is a bullish reversal candlestick, and a shooting star is a bearish reversal candlesticks. We're gonna see how they look alike. So both candlesticks have little bodies, longer upper shadows, and small or absent lower shadows. We call them inverted because these are like this is an inverted hammer. So you see, they look alike, like the hammer and the hanging man. The only difference is that these ones are inverted. Most of the time in the market, you find a hammer. You find a hammer doing a downtrend, or you find a hammer, or you can find an inverted hammer. It's all the same. Like they all mean the same, because the inverted hammer only pushes prices up, or shows that the end is near. And prices might reverse. So the shooting star, this is an inverted, in actual sense it's an inverted hanging man, but we can't call that an inverted hanging man. So we named that as a shooting star. And when you see the shooting star up, we shall see all those examples on the real chart. When you see this shooting star up, my friend, just know that you should not go in with the buys, but rather to wait and see if prices change direction. So the inverted hammer occurs when prices have been falling. This is the inverted hammer. Like you see, prices have been falling. So it occurs when prices have been falling and suggests the possibility of a reversal. Like it suggests the possibility of us reversing. So therefore, the long upper shadow or wick shows that buyers tried to push the prices higher, However, sellers attempted to push the prices back down. Since the sellers weren't able to close the price lower than the open, this is a good indication that buying pressure is building up. Now we have the shooting star. The shooting star is a bearish reversal pattern, a bullish reversal pattern that looks identical to the inverted hammer, but occurs when the price has been rising. Its shape indicates that the price opened at its low, rallied up, but pulled back slightly below the open. That means that buyers attempted to push prices up, but sellers came and overpowered them. So we can see that this is the shooting star. So the moment you see such a candlestick during an uptrend, wait till you confirm that surely buyers are exhausted, then you press a selling order. So we are having another single candlestick pattern. We have the marubozu. And I love the marubozu very much. The marubozu translates to bold. This is a Japanese word. Someone who is bold is a marubozu. So a marubozu translates to a bald head or shaved head in Japanese. So a marubozu candlestick is a bald candle which has no shadow or wick, like it has no shadow or wick. So we are having two types of marubozus. We have the bullish marubozu and the bearish marubozu. Depending on whether the candlestick is bearish or bearish, the high and the low are the same. Like when it opens and it goes up, it closes from where it has stopped. Like it has no wicks. Marubozus have no wicks, you see. They have no wicks. They have no wicks completely. They are bald-headed. So let's talk about the bullish marubozu. A bullish marubozu contains a long white body or green body with no shadows. The open prices equals the low prices and the close prices equals the high prices. This is a very bullish candle as it shows that the buyers were in control over the entire session. It usually becomes the first part of a bullish continuation or bullish reversal pattern. So, if a marubozu, we have to here. If you say candlestick, a green one is a bullish marubozu. A green one, if you see a green candlestick with no wick in the market, with no wick up or down, and then it forms at the end of an uptrend. It forms at the end of an uptrend. Just know there is no a reversal because that it has formed during the end of the uptrend. So a continuation is likely brought to occur. Like it will, the uptrend will continue upwards and upwards. But if it forms during the end of a downtrend, then a reversal is likely to occur. Then we have the bearish marubozu, and this one contains a long black body, a long black or red body with no shadows. The open equals the high and the close equals the low. So basically, this is a very bullish candle as it shows that sellers control the price action the entire session. It usually implies bearish continuation or a bearish reversal. So if a bearish marubozu forms at the end of a downtrend, a continuation is likely to occur. And if it forms during the end of an uptrend, a reversal is likely to occur. So when you see such candlesticks in the market, bro, you already know what the market is communicating to you. So we having the doji. So a doji candlestick have the same open and the close price as that, or at least their bodies are extremely short or very small. A doji should have a very small body that appears as a thin line. So basically, a doji candle suggests indecision or struggle between buyers and sellers. Prices move above and below the open price during the session, but close at or very near the open price. So when you say doji, just know that neither buyers nor sellers were able to gain control, and the result was essentially a draw. So the length of the upper and the lower shadows can vary with dojis, and the resulting candlestick looks like a cross inverted cross, or is price sign. So the word doji refers to both singular and plural form. So we have four types of dojis, and we have if you see the doji, their bodies, they're like a small stick. Yeah, like this is a wick, their body would be like this. As we talked about, the wicks always vary, so forming many shapes. So we have the long-legged doji. We've seen such candlesticks in the market. You shake a candle with that's a candlestick in the market. You don't know what's the meaning of that. So when you see such things, just know there is an indecision. And these stuffs mark zones, mark zones. We shall talk about the support and resistance, or demand and supply zones. And these things, when they come, they show whether zones are valid or not valid. So we have the long doji, leg doji. You see, it's a long leg. We have the dragonfly, and we have the gravestone doji. Not only that, we're also having this one. This one is called a 4-price doji. So guys, you can pause and before I give you the answer, give me a comment there why it's called a 4-price doji. So I get to know whether I'm already having the 1% of the profitable traders in the future on my channel. So I hope you have put the answer in the comment section. So it's called the 4-price doji runs because okay, let me use a bar, like they had the open, they had the close. But this one is called the 4-price doji runs because it has all the 4 information of this one, because this ones have the low, the high, the open, and the close. But this one, the 4-price doji, is having all of these ones. And in actual sense, it opened from here, it never moved downwards, so its lowest price is here. It never moved upwards, so its highest price is here, and it also closes from there. So all the 4 criteria are here in one place. That's why it's called a 4-price doji. Hope someone got it right in the comment section. So when a doji forms on your chart, pay special attention to the preceding candlesticks. When I say about preceding, I don't mean the candlestick after the doji. I mean the candlesticks before the doji formed. So if a doji forms after a series of bullish candles, or an uptrend, the doji signals that buyers are becoming exhausted and weakening. But if it forms after a series of a bullish or after a downtrend, the doji signals that the sellers are becoming exhausted and weakening. So guys, let's go to the chart and see how these candlesticks are traded and how they are formed, so we get to understand them in full details. Guys, now that we've been seeing candlestick patterns on the theory part, now let's see how these candlestick patterns, each and every one, influence the market on a real chart. So we talked about the spinning top, and we said that a spinning top is one with a small body and a long lower shadow and a long upper shadow, or wicks. So this one shows indecision between the buyers and the sellers, and whenever they form during a downtrend, there's a possible reversal in the uptrend, and whenever they show during a downtrend, there's a possible reversal to the uptrend. So basically, guys, starting with the spinning top, we can see that from here, we can see that we had a strong move downwards. Like we had a strong move downwards, which means it was a downtrend. But at the end of the trend, from here, we can see that we had a spinning top there. Seeing this spinning top, this is the spinning top. See, it's having a long wick up and a long wick down, and immediately us having this wick, we saw that the market had a big move upward. So From here, the market had communicated to us with a one candle pattern that our sellers are exhausted. Now buyers are going in. Now if someone came in and pressed a selling order here, he or she must have lost. But if he knew the language of the market, then he or she would have bought and make money in the market, because that's the aim here. Again, we can see that the market was moving downwards. Like we had a downtrend, and immediately at the end of that trend we can see clearly that we had a spinning top, and this spinning top when formed, we knew that a trader who's been following the channel would knew very well that now sellers are getting exhausted. I shouldn't press a selling order here, and then wait for a clear confirmation, and we shall learn them the later on videos, how we confirm patterns and see how we press a trade. So here somebody would just know that we are now going bullish. As you see very well that from there we had a strong move upwards up to this level. This is a strong move and people would make money. Basically that's a spinning. Guys, now let's talk about the hammer and the hanging man. And we say that the hammer and the hanging man, they look alike. And the color does not matter whether it's red or green. So basically the hammer forms during a downtrend, and we say hammer, there's a possible reverse on the trend to the upside. Now if you look closely, this was a downtrend, like a trend, prices were moving downwards. But at the end of the trend we had a hammer. We say that a hammer is a candlestick with a huge or a long wick downwards with either a small or no wick up. Now this one is having a wick up. Some will be having no wicks, like no wicks up, and this is a hammer. And we see clearly that after the formation of this hammer we had a move upwards, like the trend changed. And therefore if somebody knew the language of the market and has been following the channel, he or she would have made all this money into the market with just a simple candlestick, knowing where it is going. Now immediately after that, after having that move, we see that this trend up, we had a hanging man. And here we had a lot of stuff. We see we had a hanging man here. Immediately after the hanging man we had a spinning top. So no way somebody would come, because here we had the hammer, here we had the hammer and a spinning. So no way I would expect a trader to continue buying in the market when we've seen all these single candlestick patterns. And immediately we can see that we had a move downwards. So basically that's the hammer and the hanging man. Now let's talk about the dojis. The dojis also saw indecisions. We had here a doji. Dojis all mean the same, whether it's a leg doji, whether it's a dragonfly doji, whether it's a 4-priced doji, they're all the same. Now we see here a doji, and immediately after the doji we had an incision and prices moved downwards. So guys, you can go to the TradingView and look for those patterns and practice them so that you get well versed with them as we continue with our academy and the course. In the next video, you guys, we shall talk about the these have been a single candlestick patterns. Now we shall talk about the double candlestick patterns so that we can get reversed with that. And when we start doing professional technique analysis, you'll be knowing what's going on the market. So like, share and subscribe so that you do not miss out any other video.